Traders. Let me tell you something. It took me long before learning this, and I had to look at my charts every day, and after a long observation, this is what I saw. During a downtrend, the price usually hits a point where it doesn't want to drop anymore. And if there's a very high volume bar at this point of support, it could be a sign that the decline is ready to reverse. When I see a huge spike in volume, I know something important must be happening in the market. A lot of volume means many traders are interested in that part of the chart and are buying or selling there. It makes me curious, why are so many people trading at this price? I said it many times. Sometimes analyzing charts can be confusing if you just look at one thing like price action or volume alone. By watching what the price does after that big volume spike, you can get indications about what the traders who caused it are trying to do. While I was researching about using volume in combination with price action, I came across the term stopping volume. It's when the volume suddenly spikes really big and stops the price from going down anymore. And this is exactly the big volume bar I see sometimes after a market has been falling or increasing for a while. It seems the big traders are using those moments to go against the trend and start buying when the price is low or start selling when the price is high. Signals like this don't happen all the time. There's lots of ways people combine volume and price action. But focusing on extreme volume spikes seems to give one of the best signals. When one of those very high volume bars show up, it changes everything. The price either levels out instead of keep falling, or it even starts trending the other way. This can be explained by the fact that smart money saw a chance to buy from everyone who was selling in a panic. And watching for signals like this will help you to recognize when smart money are getting into or out of a market. One thing I've noticed about volume is that it often predicts what will happen with the price action better than looking just at the price alone. It gives early signs of whether an uptrend or downtrend is likely to keep going or might reverse direction soon. This is related to Wyckoff's law of effort versus result. It's the idea that if the volume isn't matching how much the price is moving, that could mean momentum is about to change. So when volume seems high compared to the little moves in price, it catches my attention. Sometimes when I see volume changing before the price, I know a reversal could be near, like after a market has gone up a lot. If the volume stays high while the price just goes sideways and can break past old highs, it makes me think the uptrend might be over. There's this volume indicator I use to show if volume is high or low compared to the average. It's called volume spread for VSA. With it, I can easily spot the candles that have very high volume. When you see red on the volume, something important is happening under the surface. When I see one of those huge volume spikes after prices have been falling, I start wondering what usually happens next. In an ideal scenario, it means the downtrend is over, at least for now. Sometimes that very high volume bar marks the beginning of an up move, and I bet a lot of traders who were expecting the downward movement to continue were caught on the wrong side. Of course, you have to be realist. Prices don't always turn right away. The volume spike can also push the market into moving sideways in a range, at least for a while, instead of continuing down or up. There's also a chance that the declining trend might keep going even after the big volume signal. That would show that sellers still have a lot of power driving it down. That's why when I see one of those extreme volume bars, I draw a channel around it to see how the price reacts. Then I only enter if it starts moving higher or lower from that range. And that helps filter out the bad trades where price stops moving after the signal. When I see a candlestick that hasn't moved prices much but still has regular volume, that makes sense to me. But one of those small range candles suddenly have super high volume, then it gets my attention. Something like a red down candle, where the prices didn't change much from the open to close, but volume spiked way up. That's unusual, and in a good way. It's going against common sense because usually high volume means a big move up or down. But in this case, even though volume exploded, prices didn't drop further. According to Wyckoff's law, the effort the volume, and the result, the price movement, aren't matching up. To me, that indicates sellers are meeting more resistance at that level, and it's getting harder for prices to fall below it. Candlestick patterns like that make me think that decline could be running out of steam. It works both ways, too. If there is an upward green candle with hugely high volume but prices didn't shoot up that much, it tells me something different is happening under the surface. When buyers push volume through the roof but the range stays small, it looks to me like sellers are stepping in more at that level to balance things out. It's the first hint the upward momentum could be fading again. Just one signal like this isn't enough. I need to see what prices do after to know if it really means a trend change is starting. If the price breaks below that big volume candle in the future, that would confirm to me it's time to short sell, since the buyers aren't in control anymore. There are two ways to trade this very high volume: to fade the move, or to trade a continuation, and that depends on the time frame you're trading. I've talked about the high volume bars, and I used to scalp the 1-minute chart with them, and it's still a valid approach. But lately I'm more inclined to swing trading, and I had to adjust the method. The goal is watching how volume interacts with price and recognizing the early warning signs, like the abnormal loom candles, before the trend turns. So here is how I would explain it from my perspective. The strategy focuses on capitalizing. When I see one of those massive volume spikes, it usually works like this. The price has been falling or rising, then all of a sudden volume surges way up with a huge red volume candle. Then I draw a box around the high and the low of that very high volume candle, and there are two scenarios. That big influx of trading stops the previous momentum and price reverses, where price continues in the initial direction more aggressively than before. If I see prices bounce off that volume candle and cross back into the box and breaks on the other side, that's my signal to jump in with a buy order. The stop loss goes below the bottom of the volume candle box to protect myself in case price reverses, and the first target is to take profits when I've made at least twice what I've risked. Sometimes these volume signals launch bigger moves, so there's potential for more gains too. So the first strategy is about fading the move that just happened on the chart, using the volume spike as my guide. The second strategy is a continuation of that move. If I see that price continues in the initial trend direction, that's my signal to jump in with a sell order. Once price returns to the box, I usually don't sell right after the breakout. Although it's a valid, aggressive strategy, I usually wait for a retest of the box. My stop loss goes above it and the same first target at least twice what I've risked. So the second strategy is about trading a continuation move, the volume spike, adding fuel to the momentum. I noticed Euro futures has been trading in a range for a couple of weeks and then started dropping again right as it was approaching this demand level. Volume suddenly spiked up not just once, but twice. Second time with a red small candle. Those very high volume spikes add demand after the decline caught my eye. Plus the signal price bar had a tight range even with the high trading volume. So I placed my box around that area and following the plan we've discussed about fading volume spikes. If Euro price breaks above the top of the box, that's when I'll hit the buy button. My stop goes below the demand just in case it continues falling and take profit once it reaches the next major swing high. This was the daily time frame, so the strategy is perfect if you have limited time for trading. If you are day trading, there will be tons of huge volume bars, but don't try trading each one. Focus on volume spikes that really stand out, especially near supply and demand levels like this one. We had an up move, then volume exploded on a small red candle at the high. If it breaks below the low of our box, a sell trade with a tight stop targeting this low looks pretty good. Here I noticed another potential setup forming. It looks like a double bottom with an ultra-high volume bar on this candle. So if it breaks above the top of that candle after the volume search, I'll take the long entry stop loss under the most recent swing low and I'll aim to cash out when it hits the next major high point. That should offer a very good profit target. In this example, I noticed a huge spike in volume with a big green candle. Since the price range was also large from the open to close, it wasn't displaying the effort versus result imbalance we looked for in the previous examples, with high volume matching a strong move up. My impression was this likely signals a continuation of the trend rather than reversal potential. And that's our second approach. We are trading continuation moves after high volume spikes. I placed my channel around the signal candle hoping for an upward breakout. As I initially thought, price consolidated just above the channel I've made. So while this volume spike wasn't an optimal stopping volume setup, observing it helped reinforce the previous bullish momentum. And as a side note, in case price broke lower, we could have taken a short trade at the retest of the box. Here's another trend continuation signal: prices have been declining and volume spiked on a big candle with high volume matching the strong down move. This likely signals a continuation of the trend. So we place the channel around the high volume candle. Since the move down wasn't reversed after the volume spike, this indeed signaled a continuation of the downtrend. If prices will retest the bottom of the box after the initial breakout, a short trade could be taken aiming for the next swing low. Another trend continuation signal, an upward move, was underway when volume exploded on a big green candle. They suggested buyers were actively testing that resistance or supply level, indicating continued buying momentum. A long trade could be taken after a breakout above the box with a stop below and a profit target at the next swing high. Another signal, a large green candle, appeared with matching high trading volume. Since effort matched the result, signaling a strong move. This pointed to further uptrend continuation rather than reversal. So we're watching for an upward breakout and we're betting that the existing bullish momentum will continue, aiming to ride the trend higher, of course. Alternatively, a short could be taken on a retest of the box if price reversed this direction. You just have to be flexible and adaptable. Now, the market can be noisy, so focusing on times when trading activity is the highest helps reduce false signals from the quiet periods. Signals seem most reliable for me during key session overlaps, like the London to the New York one. Signals formed when volume is normally low, like overnight, haven't worked as well from what I've seen, and for stocks, the first 30 minutes after the open can be choppy. In this case, it helps to wait for volatility to settle before entering, since that opening surge of volume can often be misleading. And most importantly, look for spikes near evident levels of supply and demand, Fibonacci levels, VWAP, or moving averages. These areas have the cleanest signals. This brings us to the end of this video. Let me hope you have learned something. Kindly subscribe, like and share, and guys, I will see you in my next video. Listen traders, before you make any big mistake, like paying for that expensive course, try reading this book first. This is basically what you are going to be taught by your mentor. In fact, not even everything. If you are a beginner and you have learnt only basics, don't dare funding your Forex account because you will not like the results. This book will introduce you to another side of Forex trading because you cannot like forever buy at support and sell at resistance. This book comprises of everything you need to know about smart money concepts and price action, and everything is explained simply. Grab your copy at $10 only and it will save you from a lot rather than paying for now. If you want to kick off your Forex journey, WhatsApp this number to order your copy. First come, first serve.